Welcome to the July 16th edition of Around the Valuation World. Hear it first. Of course, in my view, this is the most interesting 2 hours in business valuation. As this is continuing education, we're going to start with a disclaimer. Everybody's opinions are their own. We're doing our best. Do your homework. As we all know, the devil is in the details. So do some research. Don't use any of this without further investigating it. How to earn continuing professional education credits, CPE. There will be polling questions. If you're listening to us live, please make sure you answer every polling question. Make everybody's life simpler. If you're listening to us recorded, please answer all of the questions provided. And then sign your certifications, and the credits will appear in a couple weeks on your portion, your private page in the NACVA website. Again, our crew, I am the editor-in-chief. Brian Jones is our assistant editor, and so many more things at the NACVA. Today we have Janae with us twice, so she's busy. Roberto is off. Melissa is with us. Mike Gregory prepared some work, but he is off. Cheryl Hyder is with us. Kathy Knapp is with us. Is off. Ed Mofrad is off. Dimitri is off, and Alan Zip is off. So let's move to today's schedules. Mike Gregory and Janae Castell are going to start with essential industry updates. I think we called it valuation updates, but we're going into a new phase here. I am going to handle the portion called Build Your Brand today, and I'm going to talk about how to post to LinkedIn and other social media. Janae is then going to come back with the Financial Super Consultants Toolbox and teach the hopeless like me some Excel tips. Melissa is going to do industry compliance and talk a little bit about case law update. And then Cheryl Hyder is going to do expert insights, and that she is going to interview Jim Hitchner. We have a wonderful action-packed show. I do want to mention anyone that is a member of our association may listen to Around the Valuation World. If you want to receive credits for this well-invested time, please make sure you do register. And then also do all the required questions in order to get and certifications to get the CPE. So again, if you have not and you want credit for listening to these sessions, please register. Essential industry update. Janae is a wonderful valuation professional who specializes in corporate and personal goodwill, working with local startups, creating our new systems, as well as learning from and contributing to our industry and the body of knowledge related to our industry. Janae, I am at this point going to turn it over to you. Thank you.
Thanks, Greg. All right, I'm going to give you a presentation that Michael Gregory has put together. I've got a few notes, so if you see me glancing at those to try and add a little bit to this discussion. But Michael's done a great job putting some things that you should be aware of from the BV Wire and the BV Update. There's Michael's profile. You can go look at his link. You can grab his books. He does a lot of conflict resolution and has been a great contributor on Around the Valuation World and in the valuation community. So what we have for you today are a few articles from BV Wire about valuing crypto assets, the AICPA guide, and bonus depreciation on intangibles. A few more on the next slide. Some tips and takeaways from the New York State Society of CPAs BV event, and then a new overhaul to Pratt Stats. Then finally from BV Update, we've got a checklist for initial information request for officer compensation. So we'll dive right in. Today we're going to give you a new source to look at if you're needing to value crypto assets or cryptocurrency. You can comment on the new AICPA draft and give it a little review, see what you think of that guide. We'll also look at if the new bonus depreciation rules apply to intangibles. We're going to look at a few highlights from the NYS SCPA BV event. We're going to tell you what's coming up with the Pratt stats and deal stats. And then we're going to give you some information on the checklist from Stephen Kirkland. Okay, so there we go. There's a new source. All right. We're going to talk a little bit more about the Tax Cut and Jobs Act. Great. Okay, so our first article on valuing crypto assets or valuing cryptocurrency, it's still a real nascent undertaking, and there's still some debate on different things, but Chris Bernisky is kind of emerging maybe as a leader and someone that's developing how to value these things. According to an MIT technology review article, he looks at how to value the blockchain networks, and he's using something that he called the network value to transaction ratio. He says that's the most common ratio in looking at these things, and he kind of equates it to the transaction volume being like the earnings for other companies that we might value. So that's kind of an interesting new look at what's going on there. There's obviously a lot of talk, a lot of interest in it. So if you're interested, you can go over to the article, which is on technologyreview.com, or you can look at the BB Wire article and check out Chris Bernisky on that. So the next article that we have is coming up shortly on the AICPA release draft. So they finally released a draft on valuing private equity and venture capital. It's in auditing speak non-authoritative guidance. It's 14 chapters with a lot of examples and several appendices. The article on BB Wire gave some of the highlights in the chapters that might be most intriguing for the valuation perspective. So if you want to drill back into that BB Wire article and check out kind of where they see to go if it's a lot to take in all at once. But if this is something that impacts you, do review it. Do send comments to the email on this slide. Those are due by August 15th. Okay, so we've got bonus depreciation. Does it apply to intangibles? And the short answer was no. But do be looking at the bonus depreciation. It allows immediate expensing of the cost of qualified property, which would normally be capitalized, and that's going to be phased out by 20% each year until the bonus depreciation is completely gone in 2027. So, but right now, and until January 1st, 2023, there's an opportunity for businesses to completely expense some assets, but not intangibles. So from the New York State Society of CPAs BV event, there were quite a few little highlights on what was going on. There's going to be a fuller discussion in one of the upcoming BV updates, but we'll go through some of what was talked about. Similar to what we saw in the annual consultants conference was a discussion of the bolt-on I guess methods, to add on some of the value for what's coming down with the Tax Cuts and Job Acts to really analyze what the value for these changes and kind of take hold of what's going on. So bolt-on seems to be consistently what's discussed as how a good way to handle some of that. So Jim Hitchner says that too many business valuations are rigged, and sometimes by clients, sometimes in the projections. He says that attorneys are aware that this is going on. So you need to be aware that they're aware. So in a study of purchase price allocations, goodwill averaged 35% of the total purchase consideration for 2016. Also, Toby Tatum indicated that the courts are really asking for sensitivity analysis more and more now, and one of the ways to do that is Monte Carlo. Also, in divorce, one of the presenters indicated that you can do a smell test using ratios or lifestyle analysis. This isn't really new theory, but just kind of a reminder that, you may not be obligated to find unreported income, but you should kind of do a smell test and see if it looks reasonable, see if it really is obvious that there's something unreported. A few more takeaways were that it takes in an expedited process, 18 to 24 months to establish some IP value to boost firm value in an M&A target. So that kind of give you sort of a timeline for that. Another presenter gave the option of being able to claim lost profits or how to claim lost profits even if the firm never made money. Said it was possible, and it looked like gave some guidance on how to do so. Average price to value discounts were down to 22% according to Martin Green for the PPI discount study. And I think that was all of our takeaways from the New York State Society CPA's BV event. There's a new advisory board, which is in charge of developing this new platform, Deal Stats, which is going to be rolling out this month. So be on the lookout for that. It's going to have better search capabilities, new data fields, and easier report generation. It's going to combine the Pratt Stats transactions as well as the public stats transactions. I believe the stats given there were about 30,000 Pratt Stats and 4,000 public stats. Pete Butler, Bob Domeyer, Nancy Fannin, Fred Hall, and Toby Tatum comprise that new advisory board that's in charge of this. So we'll see what comes of this. All right, now finally we've got our BV update article. Stephen Kirkland gave some insight. This kind of echoes what we heard a couple months ago from Mike Gregory about reasonable compensation coming back into the spotlight with the Tax Cuts and Jobs Act because it has such a big impact on the deductions and things for pass-through entities that it's going to be a little bit more heavily scrutinized. So the theory hasn't changed. It's just more prominent on the IRS's radar. We're expecting it to be. So you need some information for normalizing the reasonable compensation, and Kirkland gave a good checklist for how to go through and get information and also ask for anything else that you might not have thought to ask for. That is available. The website is actually on one of our resource slides that you'll see coming up. So if you want to go out and visit that website and grab that checklist, should be a really good starting point for any evaluations, any work that you're doing to make sure that you're taking into consideration all the factors for adjusting reasonable compensation and kind of striking a balance for minimizing the taxes on the employment side, employment taxes, and minimizing the income taxes. So again, today we talked about the there we go, the crypto assets, the AICPA guide on private equity and valuation. There we go, the Tax Cuts and Jobs Act for bonus depreciation. We talked about the New York State Society of CPAs. There we go. We didn't talk about that one. Interesting. Okay, continue one more. There, the new overhaul for the Pratt Stats. There. Here's the crypto assets book that was written by Bernisky, and then also Stephen Kirkland's website. And this, if you go click on that link, it just pops up with the checklist. It's a pretty cool resource. Right.
Thank you, Janae. Wonderful. So now we will move on to a polling question. Always one of my favorite events. Janae, are you familiar at all with what's coming out with Pratt Stats?
No, not really. Other than what's popped up in like the BP Wire, not really. I know that they're combining it. And I think that the platform's just maybe going to be a little bit easier to search. I don't know. I kind of thought Pratt Stats was one of the easier platforms to work with, but it looks like they're going to overhaul it and monitor it a little bit more with that new advisory board.
Good. Yeah, I use Pratt Stats an awful lot, and certainly, in my view, the data has gotten much more realistic in the last couple of years. Maybe it's because business brokers reporting weren't getting lucky on as many transactions. And it seems like they've had some of that public information in a good amount of detail for at least, time gets mushy, at least the last year or two. That can be very valuable because that's a little easier, at least in theory, to verify that, it's not just a business broker who's doing 36 things and may or may not have gotten the details right on the transaction. So I think that's going to be great. Okay, I see me again, which I think means the polling question has been completed. And today, the next section, and we are reformatting the show. We're trying a new format. We were on the other one for quite a while. So we would welcome comments from anybody on what you think of the new format with these different segments and hopefully a little more to the point presentations, and then one a little bit longer interview at the end. So let us know your comments if you like this, if you don't like this, or if perhaps a mix of both show formats might make the most sense. But I'm presenting under the heading of Build Your Brand, which is about marketing and running your practice. And so today I am going to be talking about well, there I am, sure enough. And I mainly do business brokerage, although I probably do 25, mostly smaller valuations a year. We do anything from dispute resolutions. Every now and then we'll do an estate and gift tax. And we certainly do them for banks and others that want to verify if a transaction makes sense. And today what I'm going to be talking about is how to post to LinkedIn and other social media. Everybody is telling us we all should be doing this, and as I do post to it, and I do go to LinkedIn quite a bit, I don't actually go to the other social media in person. I see certainly a good number of us are doing it, but a much larger number are not. So what I thought I would do today is start with the very basic. How do we post to this? How do we kind of get started? And then I'll work into a little bit more detailed thoughts and next level steps with it. So our objectives today from this is, again, how to post. So what we're going to start with is a little bit on the profile page. It doesn't do you a lot of good to post if when people go see who made that post, you're not well represented. I'm going to show you how you post, which is very simple. We're also going to talk about creating content, since that's the big barrier. I know for me, that was a huge starting point barrier. I've got some ideas I've used and still use every day that makes it a little easier to come up with content. I'm going to show you a tool I use, and there's lots of these tools. This is the one I know enough about to talk about at all, that allows you to post to multiple social media at the same time. It also allows us to schedule them, because I don't know about you, but most days at 2 o'clock in the afternoon, I'm doing something besides sitting at my screen posting to LinkedIn, no matter what it looks like. And then again, the last step, which is starting to move to the next level, I'm going to talk about how to tie your social media into your website. Again, in the end, I don't know about you. While I know everybody tells me I'm supposed to give everything away for free on the web, I would like a contact, and certainly I am hoping to eventually make a sale to somebody related to what I've done on LinkedIn. And I can tell you sales do happen on LinkedIn. And I know I did it directly. It was a gentleman on my mailing list, but about 4 or 5 years ago, I sold a business to someone who found me. We knew each other. I would have never thought he was a prospect for this business. And he saw the LinkedIn post and contacted me and stated that's how he found it. And he did buy a business. So this can work. That last step of going from a post to actually knowing that's how you obtain the lead to making a sale can be tenuous. But this does work, and it's certainly more and more the future. So let's start first. You can post without having some sort of landing page, or in this case, a profile resume on LinkedIn. And I'm starting with LinkedIn because I believe for professionals such as ourselves, LinkedIn is sort of the most central and most used tool. I know when I get contacted by almost anybody, if I'm going to do work for them or possibly work with them, first thing I do is I Google them and then I go to LinkedIn and see who they are, or at least who they're presenting themselves to be. What you can see, this is my profile, and it's been sitting out there probably a long time. It's probably time to update my profile. But I did post in a little background. I've got a picture of me. Like everything on the internet, just so many things are keyword driven, and we're all rushing. So the main concepts I can tell you on this top part is, I've tried to show what it is I actually do for people. And mine is sort of, this is what I do. I have friends. I would suggest, if you're interested, Rod Burkhart recently revised a lot of his marketing. And I think his is a little more next generation. And I'm probably going to be converting some of mine. But the LinkedIn homepage is supposed to be written very first person, what you do and how you help them. And again, keywords drive things. You can also see over on the right side, I'll pull the mouse over, here's a few things that's pulled from further down in my profile. I have, I think, 2,500 connections now. I'm not sure that always helps me, although it might. And you can see contact info. Again, make sure it's easy for people to figure out how to reach you. I've seen people who even put it right here in kind of what they do. On the next page, this is the lower portion of my LinkedIn profile. Again, it's very keyword. I am probably too wordy for the current internet, but it's very keyword driven. What I'm told these days is you don't want the keyword 50 times, 2 or 3 times in the course will make sense. So my main activities are business valuation. My main activities are business brokerage. And then again, the specialties was a way to get a few more keywords in there. So if people are starting to search, do more advanced searches. There's a lot more stuff on the profile homepage. Some of the best ones are a whole lot less wordy than mine. So I'm not saying you need to put this much, but you do want to put a quick, good representation of yourself, and also think about, I talk about always that we want to think about both the people that are going to read it and the machines. The machines are how you get found. So again, on this homepage, how do you help people? Who do you help? Who do you want to have reading this? Very important. Who refers them to you? My business brokerage is 100% referral business. I have gotten contacts over the web. If they're not referred by their lawyer or accountant, the likelihood of getting it is so small. So again, my page is very much directed at my referrers, and I know social media reminds a lot of my referrers that I exist. What keywords might they be searching? And again, write in the first person. So now let's go to how to post. It's almost comically simple. Whenever you open up LinkedIn, pretty much up at the top, it says, do you want to write an article? Do you have some images? Do you have a video? You type right in this box here, and you push post. So posting physically is quite easy. From that point, though, you got to have something to say. So what we often do, what I do a lot of, and frankly, I get good responses to it, is I do searches of general articles of interest. I get an awful lot of emails and summary emails and there's a lot of aggregator products out there. And I like to read a lot of them related to the topics. I like business. Fortunately, I like valuation. I like these things. So if I see an article I like that I think would be helpful to the various publics I'm speaking to, I will make a copy of the link and I send it to my assistant and she'll draft something for me, and we'll go into that a little more. So that's a really easy way to start developing some content. I also do it related to technical articles and technical things related to what my clients and my referrers might like. And again, sometimes it's tax advice that's going to be of more interest to my referrers. But they see it, they see me, it reminds me. And the picture of Steve Jobs, we posted, and I'm going to show you a little more about that, an article that linked to an interview of him. So I'll show you that in a second. And if writing an article is too much, well, really all you got to do is scan your feed, and you can start simply by clicking on, if you're really cautious, you can click on like, and at least the person who wrote it will get a message that you like their article. Or you can just click on either comment or share. And when you click on share, that will get shared with everybody in your feed. And usually it then asks you to write a comment. So your comment and that other article will get shared. That can actually be the easiest way to start getting comfortable posting onto LinkedIn. It's extremely easy, and those articles carry quite a bit with you, quite a bit of, they can help you quite a bit. So probably the final piece I'm going to get to today, based on my time slot, is how to post on multiple social websites. I use a product called Hootsuite. And again, there's nothing magical about Hootsuite, although I do know it is a very well-respected and used by a lot of people. But basically, you log on to Hootsuite, and I think they still have a little free time. And if it's just you, it's pretty affordable. If you start adding a lot of people and adding a lot of detail analysis and things it can do, it gets expensive. But it's pretty reasonable. I think it was when I signed up, and so I'm still paying $10 a month. I don't know what it is for the base things I'm going to show you very quickly. But basically, you go in and you add any network you're already in, and you give it permission to post to it. Then you actually go in, and all I have to do is up here, I don't know if you can see it, but here's my different social medias I've entered. Here's a message, and I can just type right into the compose a message, whatever it is I want to say. I can link a document. I can do a link to another website, and what I'll end up with is a draft post. So here's one: 7 things you should know before ordering a business valuation. Okay, that's a blog post on my website. It's a link to it. We're posting it 5 places when we do post it. My assistant does the first drafts of these, and then I'll go in, modify them, and approve them. And then what she will do is she will actually schedule them. And here, this was probably last week, you can see today, Tuesday. You can do it in calendar format. You can do it in this format. But we're actually scheduling our posts out in advance. Here is the Steve Jobs, learn when to say no and why it's important Steve Jobs knows. There's that post. I had a couple other things, but perhaps if people thought this was useful, I was going to talk a little bit more about content creation and tying it into your blogs, into your website. Perhaps if people think this is useful, I will cover that another time. Here is Hootsuite's link, a little video on how to use Hootsuite. It is pretty user-friendly. 45 experts share their biggest LinkedIn marketing strategy. Half of them are not that exciting. The other half are pretty good information, but they're all quick reads. Here is my contact information, whether you'd like to contact me on this topic, around the valuation world, or any other topic. I'll be happy to talk to you. And let's go to a polling question. The LinkedIn timeline is a total rest. Does anyone actually read their timeline? I don't. Yeah, I do not go through my LinkedIn timeline. I view LinkedIn as what I do today. Certain things do tie into your homepage now, and maybe that's what's being referred to as the timeline by this questioner. Certain things do tie onto your homepage. I didn't talk about doing an article. It is good to periodically also post articles right onto your timeline. I'm also told by my experts that LinkedIn doesn't want you to make everything a link out, that they like things to stay within LinkedIn, which again is another reason why doing a comment on someone else's post is a good thing, because my understanding is LinkedIn likes that also. All right, we had another question on the LinkedIn feed. I apologize. If you'd like to contact me afterwards, I'll be happy to answer it. We are going to go on and move on. Our next section is the financial super consultants. I say that with a drum roll. Toolbox. And I'm really happy to have Janae back. And I know Janae recently went out on her own, so I'm sure all of this, I know a lot of us are small shop or single shingles, so a lot of this, I'm sure, is of first-person interest to her also. And with that, I am going to transfer back to you, Janae, and sign off and listen to what you have on Excel tips for accountants.
All right, great. Thanks, Greg. Okay, well, we'll move right on into the content for this. Today we're going to talk a little bit generally on Excel tips that can apply to your accounting practice, valuation, forensics, whatever you're doing, but not specifically pertinent to only valuation or only forensics. So the first few tips that I have are the watch window. I'm going to show you how to double click or control arrow to navigate, and then showing you how to fill it down. If you know some of these things, you've been using them, I'm sure you'll agree they're pretty good time savers. If you haven't heard of them, these will be great for you to use to just kind of be able to go through Excel a little bit quicker, not be moving back and forth with mouse and keyboard strokes, and managing your Excel worksheets. So the watch window is the first one. If you want to go ahead and open up your Excel and go through things with me, if you have multiple windows, that might be a good strategy. I know I, for one, I have to do these things to really fully understand what's going on, and it might also help if you have some questions. I am working on Office 365, and I think what I'm showing you should be still the same across other versions of Excel, but if not, go ahead and type something into the chat box and we'll see if we can get that resolved, because I've worked with 16, 13, 10, 7, whatever, and so I should hopefully be able to, and if not, we can resolve that after the webinar. Okay, so when you're going through valuations, if you're looking at financial statements, tax returns, seeing what the impact of some inputs are, it's nice to be able to see how that changes in real time. So what we can do is use something called the watch window. So you start out maybe with an input page, and this is a valuation that I'm going to show you, but it can be used for various applications. I have an input window on the left, and then on the right, I've got the actual value calculation that I may want to see. On the next slide, we'll see that you go into the formulas, and then, which is up the top, circled in red. And then the next thing, when you click on the formulas tab up there in your ribbon, it'll bring up this watch window option right there. So if you click on that, circled in red again, it'll bring up a dialog box. And in that dialog box, you'll hit the Add Watch, and then that will pop up another little navigation dialog box. The cell that I had selected whenever I hit Watch Window is what defaults into that little bar there. So discounted value, C8, that's what's going to default there. But you can move that around, navigate it to any other cell that you'd like. Then once you get the cell that you'd like, you hit Add. So I've added the value of operations, and then on the next slide, I'm going to add another cell because you can do more than one. I'll actually go back, Greg. Let's see. Oh, no. Okay. So you do the same thing. I hit that add, and then I went back to the watch window, and I hit add watch, and then it brought up another one. I hit the adjusted per share value cell, which is C24. Now you'll see that on the next slide that we've got both of those added in. Okay, so C8 and C24 are in there, and you can just watch those. Any changes that you make that impact that value, it's going to show up and tell you in real time how that changes. So go into the next slide. And if I go back in here to my input slide and I want to change the company-specific risk premium, any of these factors in here, it'll show up on this watch window right here, and I can see exactly how it's impacting the value. And I can see both the total business, the value of the operations, as well as the per share discounted value. So we'll see. Right now we've got 0, but we'll see in the next slide what it does whenever we change those inputs. If we can move on and kind of see what this does. Great. Okay, so we had our original values up there at the top. Then we set our company-specific risk premium to 5, and it pops up those second values. And we set, the CSRP to 10, and we can just see really quickly how this flows through. So you get an idea of how the changes in inputs are flowing on down the line. So watch window is a really useful thing as you're going through and doing just about anything, so you're not flipping back and forth between your tabs. In this particular workbook, I've got quite a number of tabs, but quite a number of different things that are flowing through to compute the value. So going back and forth and checking different things as you're working can get pretty cumbersome. This watch window just simplifies those things. All right, so the next thing that we're going to talk about, another thing that you can do is if you want to go and change that that cell, the watch window, you can double click and it'll take you right to that cell. So if you've got a formula that you don't think is calculating just right, just double click it and it'll take you right there. All right. Now, I'd also like to show you how you can do some quick and easy navigation through your Excel workbooks. If you go into a cell, select any cell. In this particular example, I've got the book value of equity selected. So I've just had my mouse on cell B31, okay? Just put your mouse in any cell. If you've got some data in here, you can go click on any of these borders. So this green box that's around this cell, just double click the bottom. You can double click the top, the right, or the left. And that is going to move you to these boxes that are highlighted in red, so the cells that are highlighted in red. What it does is it takes you to the end of, or the last cell that has text, or if it has a blank, depending on what kind of cell you've got selected. But so if you've got a big chart with a bunch of data and you want to go all the way to the end without taking your mouse and scrolling all the way over or pressing the arrow key 2 dozen times, you can just double click, or you just want to see the end of a data set, double click the right, double click the bottom. If you're down at the bottom and you want to go back up to the top, double click the top. Same thing. This will just kind of move you around the spreadsheet a little bit quicker, especially if you're not wanting to get in the keyboard, you're kind of mousing around and things. On the alternative, you can use your keyboard with a control arrow, and it's going to do a similar thing for you. So if we'll show the next slide and kind of talk through that. Okay, so we've got that same cell selected. Whoop, one back. Yeah, we've got that same cell selected, that B31, and this time you're entering data, you're putting and typing in numbers or names or whatever, if you want to go to the end of your column or the bottom of your chart, your table, you can just do a control arrow. Control right will take you to this box on E31 where we've got the weight. So it's a similar result. You just don't have to use your mouse. So, it's just easier if you've already got your fingers on the keyboard, instead of taking your hand off the keyboard, moving it to the mouse, double clicking or whatever, you can just hit control, arrow through, and that kind of saves you a little bit of time. It's just a little bit more efficient, doesn't break your concentration to kind of be switching back and forth with your hands. You can just move around your spreadsheet, move around little data groups. But do notice, like in this example, it won't take me up to the top of the whole spreadsheet. It's not going to take me up to row 1. Whenever I do a double click or a control arrow, it's going to take me to the last cell with text, or if I'm on a blank cell, sometimes it'll take you to the next blank, just kind of alternating, but you can keep hitting double click, or you can keep doing control arrow and get up to the top. So if you've got things broken down, that kind of breaks it up and makes it easier for you. Hey, Greg.
You got a minute, is there?
All right. Well, we've got fill down, and that's our last one.
Okay.
Okay. So this is another one where if you have a bunch of data entry to do, but you're not wanting to just type the same repetitive thing in, or for example, you've downloaded some transactions from QuickBooks or something, and you want to have a column in there with year, but it's not populated from the QuickBooks data, and it's all going to be pretty simple. We can do a quick fill down and get that data in there. So go to the next slide, Greg. Okay, our steps. Okay, here's your blank data. Go on. Okay, we're going to type in a formula in this top cell and just hit enter, and then you're going to go back in on the next slide, and you're going to hit, see that little square at the bottom right? You're going to hover your cursor over that bottom right corner, and your cursor is going to change to a plus sign. In that case, then you just double click, and the fill down works similar to that navigation that I just showed you, and it's going to fill that formula that you have in C4. It's going to fill that all the way down for each row that has data in the other columns. Now we'll see on the next slide how that can kind of come out a little bit differently than you might expect. So you've got some data in adjacent cells down to row 22, but then beyond that you don't have data in the cells next to it. It's still going to fill in that formula all the way down until the first row where there's something blank. So if you just have some notes in your spreadsheet, you've got some weird things going on, and there's not a blank before you get it, it's going to fill that that formula or that copy down all the way until a blank row is reached. Okay, so after, like here, row 30 is the first blank row. The next rows aren't going to be filled. You can also, it won't overwrite data. So here I put stop. It's going to stop right where I have that stop column. So if it finds data in that column, it's not going to overwrite it. It'll just stop filling there. So it's pretty useful. You can also go ahead, Greg. You can also go in and do Control D if you don't want to go back to your mouse and do double clicks. So there's some ways to do some control shifts or arrows and combinations to make this fill down. In similar ways, you can also Google and just kind of do fill down things and maybe find out how to do it. You can also send me a message, and I can help you with that. But it's great when you've got big data groups and you want to fill some things down. You don't want it to overwrite, but you just want to copy in some data without having to hit Control V or drag your mouse down a whole bunch. All right, so David Ringstrom does a whole bunch of presentations on these, and there's also some good information on Mr. Excel if you go to those websites. So let me know. We're going to do some different ones. I think it's on the next one. Some different presentations on Excel for valuation, Excel for forensics. Also want to do some presentations on some different components that you can use, some add-ins and software, maybe some goodwill apportionment. Maybe we'll go through maybe the deal stats, I don't know. But let me know what you think might be helpful for you to know as a practitioner. We've also got some things maybe to automate for, larger corporations where you're working on things and you need things to be a little bit more similar. So with
Fantastic.
that, that's it.
Thank you so much, Janae. Now we are going to, I missed the slide, didn't I? Now we're going to move on to a polling question. Again, if anyone has comments for Janae or myself or Melissa or for the team, do not hesitate to contact either us or the association, Chinda, and frankly anybody there, and they will forward it to us. We would like to make sure we're presenting things that are of value to you. I know I just learned 3 new techniques in Excel that will save me a lot of time. I've dragged my data around. I never quite used the click fill. I've dragged it by that little square. So, very useful techniques. And I don't know about you, but I find I spend a lot of valuation time in Excel, trying to make sure I really understand my data. So next, we're going to do industry compliance with Melissa. Melissa, I apologize. I'm a little late getting to you, which I try not to do. Here you are. I'm going to click out of the way and let you get started.
Okay, we'll just go right to the first case. So we're going to try to cover 3 cases today, and basically this section is just to give you a couple different cases that if they're applicable to you or you find them interesting, that you should go and look back and maybe read the whole case, but we'll give you some highlights. We'll also cover compliance issues or industry updates in other months. So this is a case that was in the state of California, and it was actually an eminent domain case. But it was basically a business that was being bought out, and they didn't agree with the price that they were being paid in the case. And so there were several valuation people that were introduced for the plaintiff and the defendant, and everybody was excluded except for one expert. And this expert actually came in and testified on another expert's work that had been excluded. And so, when they went to testify, and I think that the general gist of this case is that sometimes you are called upon to come into a case at the 9th hour and at the last minute and not have enough time. And I think that in this situation, this expert then came in and said, well, I'm going to testify, and maybe the attorneys even suggested this, but I'm going to testify on the work of another expert. And so then he came in to testify, said he was very familiar with the financials, he had reviewed information, he had visited the location, he had spoke with the CFO, and such. And, I think interestingly enough, he also had consulted several reference guides to draw some conclusions, which I think testifying to that sentence in general is probably not the best idea. But if we go to the next page, essentially, he did not create his own report, and he just kind of looked at some of the data from the other report. The problem is when he was asked questions, and this was, I think, by the attorney and the judge, is that he didn't have any financial schedules, and he didn't know how the excluded expert got to some of the key financial conclusions and assumptions. And he couldn't understand, and he couldn't kind of explain away why all of these numbers mix. He just had adopted it. He had basically said, he had never even talked to the excluded expert. He just assumed that that expert would have proceeded the way that he would have, and that he trusted that the expert exercised proper professional judgment, and had basically, the court had excluded him as well, which kind of makes sense, right? The courts basically said that his opinion didn't provide any meaningful assistance to the jury, which makes sense. I think then the takeaway is, what do you do in a situation where an attorney calls you at the last minute and asks you to provide an opinion and says, well, we have all these other reports, could you review them? Could you, just give us a general idea, because we need somebody to testify. One of two things: you either have to make sure that you can spend all of your waking hours to get prepared to go on the stand, or you have to say no. I think that those are two hard things, because maybe the money sounds great, but when it comes right down to it, it's actually your reputation, and when you get excluded as an expert, that does follow you, and other people are aware of it. So if we go to the next one, I think is the next case. So this was actually an interesting case, and this so anytime that these are listed as 2, that means that typically they've already gone up for trial and they come back on appeal. And so this is actually an interesting case, and we've covered the DFC Global and Dell case before, but to give you some idea, the first time that this case came in for this so basically HP was trying to buy Aruba, and those are the 2 companies. And Aruba really wanted HP to pay a compelling price that not only reflected the upside potential, but the strategic value of Aruba, and those were quotes from the CEO. So what happened was the dissenting shareholders petitioned the Delaware court to say that basically that the price that was paid, HP paid for Aruba, which was right around $24.67, and this is the first case, and then we'll go into what the slides say, that it was basically not enough, that they had an analyst that had come up with a valuation range of somewhere between $23 and $31. Again, the price was close to $24, $25. So it was in that range, and then the stock price was somewhere between 17 and 18. So they have 2 experts that come in. They both do DCF models. The court feels like they both appear sound, but in essence, they start to say, why are we looking at these assumptions of discounted cash flow method in order to derive the value of this company, lacking synergies, right? And as opposed to just looking at the stock price. So this case actually came back on appeal after the Dell case had come through. And basically the Dell case had, they had decided that you could use the market price as fair value. And in this particular case, the dissenting shareholders were kind of saying, that's ridiculous. It's absurd that, you would only get that price. And they were basically saying that this price was market mispricing, and that essentially that the market was wrong, and that there was really a different fair value price, which I think is a hard position to take, but it is the position that they took. So the Dell case comes down, and it's the same judge. And what they're trying to say is that, and even in this situation, the petitioners, I think, argued, or the plaintiffs argued, that the efficient market hypothesis was really just, kind of crap. So I think it's fascinating, because you are trying to take in, valuation theory, but at what point does that valuation theory trump what the market's saying and or what the actual deal price was? And so if we go to the next slide, essentially, in talking about this, this judge was saying that the Dell case basically changed the law and authorized the court to rely upon the market price as a fair value, as opposed to getting other valuation people in to, which I think is very fascinating. In this particular case, they did have 2 different experts that came in. One arrived at a $32 value. The other one, which was the company's expert, came at 19.75 value. Essentially, it was bought for $24, which they were kind of saying was higher than what they believe the value. All of these numbers were still higher than the market value, or the traded value. So if we go to the next slide, And so basically the Delaware court was saying, if you're looking at this unaffected market price, it really is indicative of what the price would be for and what the value of Aruba. And instead of adding on these different layers and looking at what the synergistic price is, they also had just this issue with looking at, any sort of adjustments or any sort of judgment calls is what they were saying, and why wouldn't they just use the deal price? So I think it's fascinating. I think you need to be aware of it when you're looking at these types of things. We'll try to hit one more case, and that'll probably be about as much time as we have. The final case is fairly interesting. It's actually a divorce case, and this is a situation where these courts kind of use these terms, and if you were at national conference, we talked about some cases where the courts talk about true value or true asset value, which is clearly just a judge making up a term that makes sense to them, and it doesn't really have much use in valuation theory. But there was a shareholder agreement that basically said that any time that you transact these shares, it has to be essentially at liquidation value. So of course the outspouse comes in and says, you really have to look at asset value, market value, income approach, and look at all these different approaches and not really care what the shareholder agreement had. So if we go to the next one, and it was somewhere between $179 and $220 per share, and essentially the wife, had a qualified expert that came in, talked about the different approaches, talked about the fact that the liquidation approach really would probably lower the value too low. It wouldn't be close to fair market value or fair value. If we go to the next slide. And basically the trial court actually did believe that and said that the true asset value was a little bit higher, and also wanted to note that according to case law in this particular state, that the trial court is not bound by buy-sell valuation agreements, which I think is in a lot of different states. So if we go to the final slide, I think the owner spouse, the working spouse, also wanted some discounts for lack of control, lack of marketability, some factoring in of the costs of the sale and the taxes on the asset value, which the trial court found all speculative because, again, we say fair market value, willing buyer, willing seller, but the trial court then comes back and says, well, there's really not a sale that's going to happen, so we're not going to factor in those costs. So that's where it ends up. I think a lot of the same issues, but these are some cases that you should be aware of and be mindful of as you practice in litigation.
Fantastic. Thank you so much, Melissa. I'm going to move very quickly to there's Melissa's contact. Again, I'll remind you, if you want credit for this, please register. And now we're going to a polling question. Your cases brought up a couple thoughts for me. Number one, my dad was a general contractor, and his saying in the world was, I'd rather be approximately right rather than perfectly wrong. Maybe the judge was saying, the market is probably approximately right, and this is supposed to be about the price of business. At some point, value ties into price, and maybe the market in that case was close enough.
Well, and I think it's a hard line to try to say that the deal price was above the market price, but you had an analyst that came in and said that it should have been more. And some of the other backstory was that they felt that HP was kind of, since there were no other competitors, kind of pushing them into this deal. But the court said, well, if there were no other competitors, then you kind of had to take this deal. So, they basically said just one analyst saying that it should be closer to 32 doesn't really make it the value. If you have an entire market that thinks that it's less than what you got.
Absolutely. Well, thank you so much. Thank you for those cases. And we will be speaking speaking very soon. Next, we are going to move on to expert insights. Again, both our pioneers, which I think Jim Hitchner today qualifies as, and emerging leaders are going to share their perspective. Today we have Cheryl Hyder interviewing Jim Hitchner. I see you all are both on. Cheryl is one of my go-to people, and if you want to know about interesting standards of value and you have some time, ask her about intrinsic value sometime. And with that note, I will put Jim Hitchner, I will let I will let Cheryl and Jim get started. Thank you.
Hey, thanks, Greg. So first off, we're really lucky to have Mr. Hitchner here today. He's a guy who doesn't really need an introduction, but he's getting one anyway. Greg, start rolling credits. This guy has been a thought leader as long as I think this profession's been around. He's authored countless books, countless number of articles. He's presented on, I think, every possible topic. Jim, if there's anything you've missed, I'd love to hear you talk about it. Let me know what it is. We are incredibly lucky to have you here today to talk about not the most current issue. We need the slides, Greg, or he's not going to get through his material. To talk about not the current issue of his financial valuation book, which just came out, I think, last year. We're not going to talk about his discount for lack of marketability book, which he and a few of his friends recently published also last year. We're not going to talk about his lost profits book that came out last year. We're not going to talk about his update on the Tax Reform Act, the Tax Jobs and Cuts Act that came out recently. He's got an update on that later this week. If people haven't signed up for it, hop on it. It's Wednesday, I think, Jim. Is that right?
That's correct, yeah.
What we're going to talk about today is a book that really excites me. It came out in 2016. Jim and a few of the other pioneers in our industry got together and wrote a book, The Origins. If you read the preface to the book, they kept getting a repetitive series of questions, and they figured it would be a good idea to sit down, talk about it, publish it. An update to this text. Is it an update, Jim, or more topics that's coming out?
We're going to update it. We're updating it right now, and it'll be out in early 2019.
Okay.
And we'll cover in detail the TCJA, and we're going to update the 4 main topics in there, and we'll also add new topics.
Okay, fantastic. So let's talk about what these high impact areas are, the 4 main topics where most of your questions come in. Greg? Okay, while we're waiting, there you go. So these are the topics that are high impact. It's most of the questions, Jim. What do you want to tell us about these areas? First one being the income approach.
Yeah, I mean, it's set up as a Q&A, and what was interesting is Pratt and Fishman and I have spoken a lot together, have written together, and have worked together before, sometimes against each other as well. And we wanted to come up with a book. I mean, part of the title of the book is A Consensus View. And believe it or not, we probably had a consensus on 95% of the specific areas that we cover in the book. There's a couple places I'll mention to it where Fishman did something a little different, and in another area where Pratt did something a lot different. But other than those 2 areas, everything else we all agreed on. And where we disagree, we say that in the book. But it's rare to see us disagree. And we were pleasantly surprised that we agreed on most things. So in terms of high impact, I mean, the income approach and the cost of capital within the income approach, obviously, almost every valuation has an income approach. There are some circumstances where you won't use it, so that is a high impact item. It's typically the major or primary method that's used or approach. And then we had a few of the other ones. And here's some of the questions that we're going to start with here. Should you use a capitalized cash flow method or a discounted cash flow method? And can you use both of them? Well, the concept is if you can't, if you if your company's performance is going to continue as it has in the past, there's no need to do a discounted cash flow method. It's also important to note, and we need to get judges to understand this, that a capitalized cash flow method is a discounted cash flow method. I hate to use the term shortcut, but it's a DCF with the same margin and the same growth rate into perpetuity. So in essence, you could do a DCF by just each year going out at the same growth rate, but why bother? So it's easy to do a shortcut. But they're both forward-looking, even though a lot of times the capitalized cash flow method is based on historical numbers. And in times of uncertainty, if you're using a capitalized cash flow model, you can deal with uncertainty and how you weight historical numbers, assuming you think historical performance is going to continue. You can also deal with it in a discount rate. Just make sure you're not double counting.
Right.
So and there are some areas where you can adjust the discount rate and adjust the cash flows. But a lot of times it's one or the other.
But isn't
So
it true, though, Jim, that sometimes you can and you do use both in some situations?
Yeah, there are still venues, and this is probably in a marital dissolution area, where the attorney will say, do not use a DCF. The judge here doesn't like DCFs. He likes to see numbers that are already on financial information or a financial statement. So in those situations, I'll still do a discounted cash flow model, because if I think the DCF is going to give you a higher value because there's higher interim growth rates, let's say 3 years, and then it stabilizes in the 4th year. But I also have to help my client and help the attorney. So I'll say, listen, I'll do a capitalized cash flow method as a foundation. Just in case the judge throws out the higher number from the DCF, you'll still have a value to go to. However, when I do it, the value that I believe is the one to use is the DCF value. But I may put a capitalized cash flow in there just as belts and suspenders. But the one thing is, if you do a DCF and you do a CCF, because you want that, foundation there, just in case the judge throws out one of the methods, you want something, don't average them. Either you're picking the value would be a DCF, but the CCF would be in there as well. This is explained in my reports.
Okay.
And then sometimes you can do a CCF by backing into a long-term growth rate. Do the DCF, you know what the value is, you know what the discount rate is, and you can back into what I refer to as a blended growth rate. And so I will sometimes do that as well. And again, everything's transparent. If I go to, if I testify, that's how I testify. And it's also in the book. In my report. So this stuff is all transparent.
But you're not worried about a judge or somebody saying to you, talking about and any kind of speculation that you may have engaged in by using both methods?
No, I explained that I think the value is a DCF value. And then I said, however, I was asked to also provide a value based on historical performance. Okay. So I did that as well. But I would testify that I still believe it's a DCF. I would also try to convince the judge that this capitalized cash flow method is also a discounted cash flow model. And also I'd have to convince the judge that those 3 years of higher interim growth rates, which may not have been enjoyed in the past, are relevant. So you got to really beef it up. Because if you believe the DCF is the correct way to go, and you don't do it that way because you're told that a judge doesn't like it, from a practical perspective, then you want to do a CCF, but you also have a standards dilemma, because the standards require us to use the methods that we think best value the company.
Right.
And just because someone doesn't like it, I'm not sure if that's the, so I wouldn't go to just the capitalized cash flow method. I would stick it in as like belts and suspenders.
Which is what you're saying here, know your audience.
Yes. Always know the audience.
That's generally good news here, is knowing who you're speaking to. Greg. So we know our audience. Now we're talking about the capitalized cash flow method. The questions you get there are we always using a 5-year approach to that? Is our future really defined as our past? What kind of insight? I mean, I know the insight that you're giving us on this topic. It's a lovely book. If you haven't gotten that yet, I love your book. But talk to us about
Thank
the
you.
questions you're getting on this area.
Well, weighting historical earnings is also an area where analysts who choose to do so can rig a valuation. It's a high impact item. So, excuse me. So you have to be careful about weighting earnings. Also, when you weight earnings, a lot of people don't think about this. When you're weighting historical earnings, you're basically risk adjusting the cash flows. So you are dealing with a risk adjustment, because if you believe the last 3 years are more indicative of the first 2 years, and you weight them heavily, 5, 4, 3, 2, 1, you're actually risk adjusting your cash flows. So you have to keep that in mind when you're developing your discount rate. A lot of times analysts will put a discount rate together without thinking about the cash flows that they're capitalizing. So again, be careful that you don't double count on, I had a case recently where 2 of the experts on the other side double counted a whole lot of areas. They had made all these adjustments in the cash flows and then also listed those same areas for their specific company risk. And we called them out on it saying you've adjusted it twice. And so your specific risk should be less because you've already made adjustments in the cash flows for these areas of concern based on the company's historical and anticipated performance.
So you really have to know what's in your recipe before you can try and bake that pie. Is
Yeah, you have to. I mean, the foundation of corporate finance is that the discount rate has to reflect the risk in achieving the projections, and that projection could be a weighting of earnings, historical earnings, and a lot of people ignore that. You have to connect the two.
Right. All right. So I think you have an example for us coming up next with how you're going to prove your DCF is the most reasonable method.
This is an area that drives me crazy. Someone does a DCF, someone does a CCF. They get vastly different numbers, and then they weight them 50%. So in this situation, what's this company worth? Is it worth $8.5 million? I don't think so. I think if the DCF is the correct value, then it's worth $10 million. And that goes back to my caution about weighting these earnings or weighting values. I mean, weighting values based on different methods is a way to get a desired result. And so, and then you can see right here.
So if I'm looking at a weight of 50%, are you not inherently, to an uneducated reader, just basically telling them that I believe each of these are equally valued and equally reasonable to use? Isn't that what you're saying when you apply a 50% weight?
Yes, and that doesn't make any sense when one value is 10 million and one value is 7.
Exactly.
So, I mean, if the DCF value was 10 and the DCF was not, CCF was 9.5, who cares? All right. I still wouldn't weight them. I'd go with the DCF.
Right.
But when they're this far apart, you either your data's flawed or your application of the methodology is flawed, or both.
Okay.
All this means is the value is incorrect. It's wrong when you do this.
You're getting no argument. Let's talk about evaluating your long-term growth rates for reasonableness. Greg, can we move ahead, please?
Yeah, let's stay in a normal valuation zone. I once had a lawyer say that you value this in the forever, right? Into perpetuity. And I said, yeah. And he made a joke. That's a really long time. Excuse me, but it is. But if we can go to the next slide. Be careful with the long-term growth rates. Some analysts will get a growth rate from an industry source and without checking to see if it's a real growth rate or a nominal growth rate. Nominal means real growth and inflation. For example, if an industry source says the number of widgets will grow, excuse me, by 3% for the next 5 years, that's a real growth rate. So you have to tack on the inflation. But if the industry source says revenues will grow at 3% or 5% a year, that's a nominal growth rate because that includes increases in the product or service and also increases in prices.
Right. Greg?
And the next slide has a few resources that I use to determine long-term growth rates based on the performance of the U.S. economy. In here, there's www.measuringworth.com, which is a free website to get historical numbers going back into the 1800s if you want.
Oh.
And then the Livingston Survey from the Philadelphia Reserve Bank puts out a 10-year projection economic forecast. And it comes out in June and December of each year. And also on the next slide, I'll show you some of those growth rates.
Now, what
As you can see here,
but what you're doing here is you're measuring these growth rates against what they're telling you in the company is their growth rates for reasonableness. Is that what you're doing here?
Yeah, that's exactly right. I mean, it's just a sanity check for me.
Okay.
If I see someone using a growth rate higher than the anticipated growth in the U.S. economy, that's a red flag for me. So, I mean, if you go to the prior slide, you'll see some of the more recent information. Which next slide after this. Okay, as you can see, right? Well, I'm just gonna. Yeah, that's it. As you can see here, the forecasted nominal GDP every 6 months since June of 2016 has been 4.6. It's been going down for 10 years. The forecasted nominal GDP. So now I'm looking at this and saying, for 3 years it's been 4.6. If I'm going to have a growth rate higher than that, I'm going to have to explain why and how the subject company is going to grow at a growth rate long-term, very long time, greater than the growth rate of the U.S. economy. It's not the only benchmark I look at. I look at industry growth rates and so on, but it is the primary one I look at. And so right now, if somebody's above 4.6%, I want to know how that's going to happen. And if you take a calculator and grow the U.S. economy at 4.6 a year for 1,000 years, and grow your company's value at 6% a year for 1,000 years, eventually your company is going to be worth more than the entirety of the U.S. economy, and that's due to compounding. I mean, if you're growing something at 6%, that just compounds. Right. And eventually you're going to overtake even the U.S. economy.
And that's what the attorney was talking about in the beginning. It's probably not realistic. It's one of those big guys.
No, there's very few companies that can do that forever. They used to say Coca-Cola used to say they could do it, and they probably did it for a century. Right. But they can't do it anymore.
No. All right. Greg, can you advance this, please? Go ahead. I'm sorry, what?
I said we got some polls here.
Yep.
I do monthly webinars, and we do the same polling that you do here. And I always like to poll to see what people are doing. And we get somewhere between 200 and 600 people on our webinars. And just to give you an idea of the number of people that are voting here. And obviously we do this for NASBA reasons, as you guys do as well, and to do in the polls. But in the last two polls we took, 95% of the people said the long-term growth rate would be 5% or less. So I think other people are also looking at nominal GDP. And the next page, you'll see a little bit of another poll. And again, you're getting on the next slide, 92%, 5% or less, 90%, 5 or less. So the takeaway on that is if you're reviewing a report, and it could be in your own shop, where you're doing it and you have a growth rate above 5%, I'm not saying don't use it. There could be, circumstances that could apply,
Right.
but I would check everything and see if you're still comfortable with that.
It depends on too many variables to say yes or no right off the bat. It's that due diligence thing you keep coming back to.
Yeah, I see a question here. Why
Yep.
not the long-term treasury rate? Demoterin presents an analysis that shows it correlated. He does. And that's running, he uses 10-year treasuries. They're running around 3% or so. So he's using, he believes that could be a long-term growth rate. Some people are using 3%. It's also some of the courts in Delaware. I know we covered 2 Delaware courts here. I look at them as well. I've looked at the risk-free rate and also inflation plus a little bit. And right now, inflation plus a little bit is 3%. But I don't believe 3% is the right long-term growth rate for every single valuation you do. But the sweet spot's probably somewhere between 3 and 5, 5 being maybe a little on the high side.
I think we're going to talk about the difference between your 10 and Demoterin's 20 in a little bit. So we're going to hold off on that fellow's question. Now you've got a couple of data sources, it looks like here. Why don't you tell us about this?
Yeah, when you're doing, a lot of us use RMA to get ratios, particularly ratios that'll tell us what the industry's working capital as a percentage of revenues is. Well, they actually do a working capital turnover ratio, so we just invert it. However, the working capital ratio that's in RMA is a direct to equity ratio and should only be used in direct to equity valuations. If you're like me, I do a lot of work in the using invested capital, long-term debt, capital leases, plus equity. And then I subtract out the debt to get to the equity. That's just the way I grew up. I was taught that way and I grew up that way. You should get the same answer regardless of whether you use direct to equity or invested capital methods. But if you want to use RMA and you're using an invested capital method, it doesn't have that. So you've got to determine it. And here's the here's the layout, not the formula, but the layout to determine a debt-free working capital. Debt-free means short-term notes are out and the short-term portion of long-term debt is out. And then you're purely debt-free and you have a pure invested capital. So, and this can have a substantial difference on the percentage of revenues that you're deducting from your cash flows to fuel future working capital growth.
And the book has a discussion about this topic because RMA was controversial for a while. I don't know if it still is, but you guys do have a sufficient discussion in here that folks can grab it and pick it up and understand how
Yeah, all this is explained and there's examples and, and then there's comparisons of a direct to equity working capital turnover ratio and the one that we're recommending here.
Okay.
So if you're using invested capital model and you're using working capital off of RMA, it's wrong.
Happens a lot. All right, talk to me about the difference between Gordon growth model, if you would, and exit multiples. There's just a lot of confusion.
This comes out the terminal year of a discounted cash flow model. Investment bankers often use exit multiples. There's nothing wrong with the use of an exit multiple. Let me say that first. But it's often abused and often results in too high a value. So here, what we do is we use the Gordon growth model. If it's a 5-year DCF, take the 50-year cash flow, grow it at the long-term growth rate, and divide it by discount rate minus the growth rate. That's Gordon growth. Some people will take the EBITDA number in year 5 and multiply it times a multiple often based on public company multiples in part. However, if you apply an exit multiple, it's okay to do that, but inside that exit multiple is a long-term growth rate.
Right.
And so you can now back in to whatever exit multiple you're using, you can back into the long-term growth rate. And I have an example here, 5-year interim period, discount rate's 20%, and so on down the line. Here's the formula. and you plug in the formula, take a look at this. A multiple of 4 implies a long-term growth rate of 6.7. Well, that's way over the 4.6 that's been predicted for the last 3 years, and that upper bound of 5%. Now, 4 might not sound like a real high multiple, but at a 20% discount rate, and you can see how the growth rates. So if somebody's using an exit multiple above 3 or 3.5, they're going to come up with very high long-term growth rates, which don't make any sense. Nobody's going to grow every year into perpetuity at 9% or even 7%. They may do it short term. Then the next slide also shows that with a discount rate of 15%, an exit multiple of 5 will get you a 4.5% long-term growth rate. Multiple 6, now we're in to la-la land again, 6.2%. But if you're valuing smaller businesses, a lot of the times, I'm not talking about mom and pop shops. I'm talking about smaller businesses. Your discount rate, equity discount rate, is going to probably be in the high teens, low 20s. And so that prior slide shows how quickly you can end up with a long-term growth rate that's not supportable.
All right, Greg, can you give me the next slide? Let's talk about your terminal year. Midterm.
Yeah, this still comes up. The bottom line is if you're using a mid-year convention, and let's say you have a 5-year model, you use it in every year of the model, including the terminal year. Other practitioners say, well, that's not right. You need to use it for the first 4 years, and then the terminal year should be at 5. That's incorrect. I've had this proofed. I mean, and I've had, I've worked on this, I've been doing this for, I don't know, almost 40 years. And I had somebody from the Wharton School, University of Pennsylvania, proof this 25 years ago. And then there's also a simple proof. If you go to the next slide, there's the formula for this is the formula. As you can see, the net cash flow of the terminal value, it has a N, the year, 4.5. This is the correct formula. Now, if you go to the next slide, you'll see that the value, doing it correctly at 4.5, is 8.3 million. Now let's go to the next slide. You'll see the incorrect value is 7.9 million. Also, a real easy way to figure this out is to, in Excel, take your terminal year, and if your long-term growth rate as is here is 4%, take it out 100 years, all right, until the present values factors are so small they're insignificant. Well, I told one of my analysts to go ahead and do that, and he said it only took 66 years out to get to the correct value. So this is another simple proof, this using a simple Excel model to show that the terminal year should always, if you're using a mid-year convention, the terminal year should always be present value at the half year. 5 is incorrect. 4.5 is correct. It still comes up and what happens is it's called I call them legacy issues. They've been doing it so long at this way, they don't want to change because then they have to admit for the last 20 years they've been doing it wrong. So there's a lot of, I call them legacy issues, is people don't want to change.
Right.
So
Jim, let's take a minute for some of these questions that are coming in. I think they're on your screen as well. Why not estimate return on investment capital, reinvestment rate, and inflation to vary across firms?
You are assuming that the discount rate for cash flow is the same as the discount rate for EBITDA. Well, that's what the investment bankers do as well. At a minimum, you need to adjust pre versus post-tax. No, you don't. I don't mean to be blunt, but you don't. Because the EBITDA multiple is based on capitalizing EBITDA. But if you take a multiple of EBITDA, the value that you get, even though EBITDA is pre-tax, it's an after-tax value. Just because EBITDA is pre-tax, the value itself is after-tax because the price of the public company, if you're using public company multiples, is the price of the company that pays taxes, corporate taxes. So just because, so you would present value it at the same discount rate. I've never seen it done any other way. But it's a good question because it led to the second answer. where just because you're using a pre-tax multiple doesn't mean it's a pre-tax value. It's an after-tax value.
Right. Now, the second question here that popped up is why not estimate your return on invested capital, the reinvestment rate, and inflation? Why not estimate all of them?
Well, this is something you should be looking at. I mean, one of the I'm going to get into another area this is going to prompt me on. This is a good, I agree with whoever gave the question. This is a good thing to do. And one of the problems is, and I called Chris Traharn up a little while back, and I said, these S-Corp models are all messed up. You know, most of the S-Corps I value only distribute to the level of the cash. I'm sorry, to the tax burden. So where's the rest of the money? Where's it go? And so it stays in the company, and that value will grow. So that's where you need to look at return on investment, returns on investment on a go-forward basis. So I would agree with that question.
Okay.
It's something to look at.
I think you touched on this a minute ago, but the next slide, you're going to let everybody in on a dirty little secret if they're not already aware. I think Melissa, I think, touched on this earlier.
Yeah, I have a growing number of valuation dirty little secrets. The one I just mentioned is a dirty little secret. Most analysts ignore cash that's not distributed but stays in the company. And so that adds value to the company. Yeah. So I mean, after 5 years of keeping the cash in the company, you're going to, you know, at the end of the 5-year period, there's a lot of value in that cash. And that gets into reinvestment rates based on the cash as well as the risk in the achieving cash flows. The other valuation dirty little secret, I mean, I do mostly dispute work. And, you know, if someone gives me a set of projections, often what happens is if I'm working for the outs and the other sides, we're obviously working for the ins, management may prepare projections, give it to the appraiser on the other side. What I do is I say, I want to see the original data that the management people gave to the appraiser, and then we check that against the Excel models. Almost never does anything change. The appraisers, the analysts are just taking management's projections. They say they do due diligence, they don't, and they just plug it into their models. Now, these are the same analysts that are making, you know, 20 changes to 5 years of historical financials, but they get a projection from a client and they don't change anything. And then we find out they really didn't push hard, and they didn't, you know, if I'm working on the side that's preparing the projections, I push hard on them. And sometimes we make changes. Sometimes they convince me no. I mean, it depends on the sophistication of the people putting this stuff together. I mean, I've had some extremely sophisticated clients that really know what they're doing with projections because they're used to doing it. And then I have a lot, probably more than that, have some semblance of a projection because they prepare budgets. Right. Then you have some companies that don't do projections or budgets. So,
but what you're doing
with very little secrets.
But what they're doing though, I mean, do you ever go back to these guys and say, hey, these are great projections. I appreciate that you prepared them in contemplation of litigation. What did you give the bank last year so they would true up or re-up your loan? Can I have that projection and compare the two? Do you ever get involved in that stuff?
It's funny. We'll spend all this money doing it, discounted cash flow, public company method, transaction method, and so on. And then I'll ask for bank information. And then I look for the value that they put on the bank statement to get a loan.
Yep. That
goes into my report. And you would not be surprised, I suspect, how often a trier of fact hones in on that number. Now, the other side's going to say, well, I wanted a higher number because, you know, I wanted to get this loan. And then the next question is, you do realize that that's against the law. That's a crime.
Jim, I had a guy tell a judge, I used that value because those facts were convenient for what I needed.
Okay.
True story. So,
well, that's not the way the FDIC thinks of things. So.
Yeah, no, I think there's a rule about that, but that's a whole nother presentation. We can talk about that offline. All right, so all that good stuff so far is just in Chapter 1. Talk to me about modified CAPM and the build-up method, if you would. Cost of capital.
Sure. In my shop, we have Excel files, and we have them for a modified CAPM, which means CAPM plus specific company risk and size premium, and then a build-up model, which is the same thing without a beta. We'll run them both. Now, sometimes we'll run them all, okay? So we'll run the MCAPN with betas from public companies if we can find them, and the build-up model using the industry risk premiums that are now Duff and Phelps. Sometimes we find such good comparable companies, guideline public companies, we'll say we're going to go with the beta analysis, we're going to go with modified cap, and then we're not going to go with the build-up model. But every valuation we do, we attempt to use them both. But at the end, after we're done, sometimes we'll throw out the bum if we have good betas. Sometimes we throw out the MCAPN because of the reverse. The betas aren't very good because the companies aren't very comparable. So then we'll go to a build-up model. And there's some visible people in the valuation area that have said that the build-up model should never be used. Those are the people that say the build-up model should never be used are those, I think, that don't value small and medium-sized companies. So what are you going to do? You value a local hardware store, and then use Home Depot as a comp? I don't think so.
Well, they could. Doesn't mean it will be right.
Yeah, they could. Oh, absolutely.
All right. So a couple years ago, I'm sorry, what?
Let me interrupt, and I think we need to do a polling question,
Okay.
and then we're going to get to one or two more of these, and then we're probably going to do another polling question and wrap. Time is getting away from us, as it does when we have really good stuff. There's my polling question. I'll try to get us back to the right page as soon as everybody comes back. If you all want to keep talking, we just need to get this poll in there.
Yeah, I mean, I'll cover some of the rest of chapter 2 right now while we're doing the polling. I use Chris 10th decile, and I use Duff and Phelps risk premium study 25th. I've had a lot of good success with doing courtroom. I like using both. A lot of the audience is probably only using the Chris old Ibbotson data, but the Duff and Phelps data, risk premium data, they have two data sets, Chris old Ibbotson, and then Duff and Phelps risk premium study, which they've been doing for years. The risk premium study has a lot more detail than Chris. Cheryl, you mentioned about Demoteran uses a 10-year rate, and why do we in the valuation industry profession use a 20-year? Well, if we could get a 30-year that goes back to 1926, we would. But there is no 30-year bond that has been issued every year since 1926. So we use 20 years, which is the longest U.S. Treasury bond that has been issued and we can get data on going back to 1926, which is the beginning point for the CRISP data. The reason Demoteran probably uses a 10-year rate in the finance community is the rate. People always compare things to the 10-year rate in the finance and investor community. But we use a 20-year rate. If they had 50-year ones, I'd use 50. But the longest one we have is 20, and that's the reason that we use it. And all the Duff and Phelps data is based on 20-year treasuries as well.
That's a pretty good reason. That's covered in chapter 2. I believe there's a whole bunch of questions in your book on that. Dr. Demoteran also talks about the question that came out maybe 10 years ago at first. Does size matter? You want to spend a minute?
I wish we didn't call it the size premium. What we should call it is the CAPM adjustment model. Okay. Because what they do, they say, this is the CAPM, this is the expected return, here's what you actually got. It's historical, it's mathematics. So, and it tends to be more so in smaller businesses. So they called it a size premium. I think the correct nomenclature should be CAPM adjustment method. But it is what it is. And if you don't use the size premium, you're going to severely overvalue a company. Because what's the size premiums running? Around 6%? That's a big knockoff. Now, Demoteran says, well, then you need to make, what you can do is if you have additional risk, model it in your projections. Well, that's a theoretical answer, and that's okay. But from a practical view, if you're doing 100 valuations a year in your shop, good luck doing that. So size does matter, and I still think the size premiums are supportable. So does Pratt and Lebowski. They're on the record saying they still believe the size premium is relevant.
Right.
And so does Jake Fishman, who's the other author on the book. So we can just go to discounts and premiums. We'll cover that.
Okay. Sure. I'm going to just let you.
I'll just try to, but the discounts and premiums, there's a distinction between liquidity. We define liquidity as instant sale, cash within 3 days. So if you don't have that, then you have a discount for liquidity. For example, if you own 100% of a closely held company, you can't sell it right away and get cash in 3 days. So even a 100% interest may have some liquidity problems in it as well. So, and then, you know, and we, in the book, in this chapter, we deal extensively with the differences between marketability and liquidity, and we have newer levels of value. Another area, it's on the next slide, is should you take a lack of liquidity discount for a 100% controlling interest? Some people say yes. In this situation, Pratt says yes. And I was in a case on the other side of him where he said, I was a consulting expert. I didn't testify, but the judge, he wanted 30%. The judge gave him 20. But Fishman and I don't believe in taking lack of liquidity discounts for 100% control valuations, but Shannon is a big proponent of it. So that's one of the very few areas that we disagreed with. Another one is, should you be using Mercer's QMDM? I think you should. I use it. I use it in litigation. I've had a lot of success with it, and I like it. Option models are starting to infiltrate regular valuations outside of the fair value world. The fair value world, people are using option models for discounts and premiums, but that's now in the last few years entering into discounts for lack of marketability. And do I still use Mandelbaum factors? You better believe it, although we've expanded it to about 40. And that's in our DLOM guide and toolkit. And then the last thing I want to cover on BV standards, the most important thing, is that if you don't know about this, Jim Allardine, Ed Dupke, and I were asked by the AICPA to prepare FAQs on calculations and their use, and they're out now. So they are officially out, the frequently asked questions. The most asked question is, can you have an opinion of a calculated value? The answer is the AICPA neither prohibits nor endorses the use of the word opinion in front of a calculated value. And it neither endorses nor prohibits an opinion of a calculated value in a litigation setting. So I don't use calculations in a litigation setting. I refuse to use them, but I've talked to other practitioners that have had success using them, and and the other side is using them, and so on down the line. But this is an area where strong feelings exist. The people that don't believe you can have an opinion of a calculated value feel very strongly about it, as do the people that think you can. But the important thing is the AICPA neither endorses nor prohibits the use of an opinion of a calculated value.
Fantastic. I think we are going to wrap there, move to our next polling question. Again, and Jim, stay on because there's a question or two that maybe you can address during the next polling question.
Okay.
Certainly, Jim's materials are out there. I just recently bought the Lost Profits book that was referred to. I don't even do lost profits, but there's just fantastic, useful information even for straight valuations in there. With that, we're on the polling question. And Jim, I think you can see the last question or two if you want to take a shot at them in a half or less.
Using an industry risk premium is similar to a beta for the industry. It is a beta for the industry. because industry risk premiums are based on betas for the industry, which includes a wide array of companies based on size. So when you're valuing a small business, don't you need to adjust the industry premium for size? No, you've already adjusted for size in the size premium. And also, if you take a look at the companies that are in the industry risk premium, where they can get a beta, there's a criteria for the data they use to go into an industry risk premium. And typically only larger companies are going to be able to have that type of data available, which enables them to come up with an industry risk premium. So I would not do that for size. Last questions. Build up to alternative is adjusting beta for lack of diversification. Asset pricing models are not meant to capture discrete risk, and so should be adjusted for separately, not in a discount rate. By always adding to the cost of equity, you may avoid overvaluation, but create issue of knowing when something is undervalued or priced. It's a long question and comments. Essentially, there is a thought that when we add specific company risk, we're taking it out of a diversified portfolio environment. If it was in a diversified portfolio, maybe you don't add in a specific company risk. That's the thought pattern that's going on with that. So that's what I think this questioner is talking about. Some people believe that specific company risk reflects the lack of diversification for the fact that a lot of business owners, all their money's in mostly in one asset, and that's their business. And I think that's the last question.
Fantastic. Thank you so much, Jim, for being available to us. And we really appreciate it. Thank you, Cheryl, for all that preparation. I want to thank all the correspondents who assisted us today. And next month, we are broadcasting on Monday, August 20th. Again, same bat time, same bat place, 1 o'clock Eastern and sliding back from there. And with that, I would like to say thank you, and we look forward to seeing, or at least being seen by you all next month. Thank you very much.